Boeing isn't just building planes, it's navigating geopolitics. Just days after confirming that China has officially stopped taking deliveries of Boeing aircraft, the company's CEO made a rare and direct statement. They are actively remarketing dozens of jets originally built for Chinese airlines. At the same time, Vietnam is stepping in a move that could reshape regional aerospace dynamics. Vietnam Airlines has signed a provisional deal to purchase 50 Boeing 737 MAX jets backed by state financing. What we are witnessing is more than a supply chain shift. This is Boeing repositioning itself in the geopolitical order, at a time when US-China relations remain fragile, and Southeast Asia is becoming a new battleground for economic influence. In this video, we'll break down three core themes. First, how global political sentiment is reshaping Boeing's commercial future. Second, the financial and operational overview of Boeing's latest earnings. And third, a fair value estimate of Boeing stock using DCF and analyst assumptions. Let's get into it. This is not financial advice. No buy, sell, or hold recommendations. Always do your own due diligence. When China shuts the door, Boeing doesn't wait. Vietnam just opened a new one. The ongoing trade war between the US and China has stalled the delivery of nearly 50 Boeing aircraft originally destined for Chinese airlines, with 2 already returned and 1 more en route back. Boeing CEO Kelly Ortberg confirmed the situation and noted the company is actively remarketing the completed jets, including 41 fully built units, to alternative buyers. Speaking to CNBC and during an investor call, Ortberg emphasized that not a day goes by without direct engagement with US government officials, including President Trump himself. He warned that Boeing's ongoing recovery could face major setbacks if other countries follow China's lead. The financial exposure is significant. The halted deliveries represent over $1 billion in at-rate revenue, on top of roughly $500 million in additional supply cost burdens tied to tariff disruption. Further complicating matters, Boeing's global supply chain is now exposed to retaliatory tariffs, with key partner in Japan and Italy facing a 10% universal duty. While no critical supplier failures have yet been reported, the risk profile has clearly shifted, and Boeing is monitoring it closely. As China retreats, Vietnam is stepping forward. Facing a 46% tariff threat from Trump administration, Hanoi has begun formal trade talks with the US and pledged to buy more American goods, including aircraft. The clearest signal came with Vietnam Airlines' preliminary deal to purchase 50 Boeing 737 MAX jets backed by Vietcombank financing. Vietnam is also reportedly considering acquiring Lockheed F-16 fighter jets to modernize its aging fleet, potentially turning the trade negotiations into a strategic realignment. If finalized, the deals would not only ease Vietnam's $123.5 billion trade surplus with the US, but also deepen its shift away from China's and Russia's defense ties. Boeing now finds itself at the intersection of commercial recovery and global tension. While aircraft demand remains strong and Airbus struggles with capacity limits, Boeing's position as America's largest exporter makes it vulnerable to political blowback. Still, Boeing's ability to redirect orders from China to India, Vietnam, and beyond gives it rare flexibility. In the short term, backlog and cash flow remain intact. But over the longer run, the company's fate may hinge less on engineering and more on diplomacy. Can Boeing navigate a world where tariffs shape trade routes as much as demand does? Boeing reported first quarter 2025 revenue of $19.5 billion, up to 18% year-over-year, while narrowing its net loss to $31 million from $355 million. Core operating margin turned positive at 1%, up from minus 2.3%, reflecting stronger operational performance and higher delivery volume. Operating cash outflow was $1.6 billion, with free cash outflow totaling $2.3 billion, largely due to working capital timing and increased aircraft deliveries. Cash and marketable securities declined to $23.7 billion, while consolidated debt edged down to $53.6 billion. Boeing maintains investment-grade credit ratings and $10 billion in liquidity through undrawn credit facilities. CEO Kelly Ortberg stated that Boeing is on track to return to positive cash flow in the second half of the year, supported by delivery ramps-ups and ongoing cost discipline. The company ended the quarter with a $545 billion backlog, underscoring sustained long-term demand. The commercial airplane division delivered 130 aircraft in first quarter 2025, up 57% from the prior year, generating $8.1 billion in revenue and significantly reducing its operating loss. The 737 and 787 programs continued ramping up production, while the XXX entered extended FAA flight testing, with first delivery still targeted for 2026. Boeing secured 221 net new orders, pushing its commercial backlog to over 5,600 units valued at $460 billion. In addition to higher deliveries, the segment's operating margin improved from minus 24.6% to minus 6.6%, signaling operational progress. Major orders included 20 777-9S and 20 787-10S for Korean Air and 50 737-8S for BOC Aviation. Ortberg reiterated Boeing's goal to raise monthly 737 MAX output to 38 units, aiming for a mid-50 cadence as supply chains and regulatory conditions below. The Defense, Space and Security Division posted revenue of $6.3 billion, down 9% year-over-year, but improved its operating margin to 2.5%. Operating income rose to $155 million, reflecting more stable program execution. During the quarter, Boeing secured a key contract with the U.S. Air Force to develop the next generation F-47 fighter. The segment's backlog stood at $62 billion, 29% of which came from international customers. Global Services delivered $5.1 billion in revenue, making it Boeing's most profitable segment this quarter, with an 18.6% operating margin. The unit supports customers through aftermarket services, training, maintenance, and digital solutions for both commercial and defense operations. Highlights included the 100th delivery of 767-300 Boeing converted freighter to SF Airlines and U.S. Air Force contract for F-15 electronic warfare upgrades. Boeing also announced a pending divestiture of portion of its digital aviation solution business, expected to close by year-end pending regulatory review. Boeing stock has been volatile, but what is its true intrinsic value based on fundamentals? To answer that, I apply the discounted cash flow method, a model that prioritizes future cash flow potential over short-term market sentiment. DCF is especially relevant for a company like Boeing, which operates on long lead times, with a vast backlog of aircraft orders and long-term defense contracts. For this valuation, I use a normalized free cash flow of $6.5 billion based on 2026 analyst estimates from Bloomberg and Refinitiv. I applied a WACC of 8.5%, which reflects the median estimate among analysts and balances two realities. Boeing is part of a capital-intensive, high-barrier industry with limited competition, essentially just Airbus, but it also faces global political risks and quality control issues that it faced last year. With this assumption, Boeing's fair value comes out to approximately $124 per share. Despite recent setbacks, the market remains optimistic. Boeing still holds a $500 billion order backlog, and with Airbus constrained by production capacity, Boeing is well positioned to reallocate orders, particularly to emerging markets like Vietnam and India that are stepping in to absorb demand once they steer for China. If you found this breakdown useful, hit like, subscribe, and let me know in the comments. And turn on notifications. I'll see you in the next one. And if you are holding, if you found this breakdown useful, hit like, subscribe, and let me know in the comments. I'll see you.